Brenda, you first. You've heard what Adam Parker has to say. Is he dead on, or is he just playing crazy and being as optimistic as he sounds?
I don't think he's crazy, but I will say I think we're in an extraordinary period where there is just a lot of conflicting data. Even the real economic data is conflicting with itself right now on many levels. But I think, if we look to corporate earnings, to Adam's point, corporate earnings are hanging in there, and they appear as though they're still going to grow this year. And that's a really important element here. But I think, that we still need to get through a lot, especially later this month when the Fed's balance sheet really does start rolling off, starting on June 15th. And then I think if the market really does start to recover, that's just going to loosen financial conditions. And that's not what the Fed wants. So I think the Fed needs to talk tough right now. The last thing they want to do is to have long-term inflation expectations move up significantly, because that just creates even more of a problem for them to deal with. So I think things are fundamentally still okay, but I think we're in for a choppy period here. And I think if we do see CPI starting to come down, which I think it should, just based on a lot of the comments from goods-related industries suggesting there's discounting going on more recently, I think that will be a good reassurance for the market that perhaps the Fed doesn't need to be more aggressive. But I think we're just in for some uncertain times here and probably more choppiness until we get a little bit more clarity.
Yeah. Speaking about talking tough, Rob Steitz, the Fed's certainly doing that. Other people are talking downright gloomy in terms of Jamie Dimon and his hurricane scenario. Tom Lee comes on today on the halftime show, says we could still go to 5,100 this year, another 1,000 points on the S&P 500. Parker sounds pretty confident. I'm not saying he thinks we can get there as well, but he's not gloom and doom. What are you?
Here's the challenge, Scott. The stronger the economic data and the markets are, the more it emboldens the Fed to tighten policy. And, we had been expecting a relief rally. We got it. In our view, it looks like it's over today.
Oh.
And we expect markets to be stuck in this choppy, volatile kind of framework because it lacks Fed support. And ultimately, we think earnings estimates have to come in. In addition, the probabilities of a recession have gone up, we think, quite a bit, and yet markets are still priced at 18 times earnings. So as we see the consumer fraying and the Fed needing to see things get worse before they can get dovish and make them better, we're just going to use relief rallies to rebalance portfolios, sell out of low-quality, expensive, low-conviction stocks, and rotate into high-quality positioning. I think when you hear guys like Jamie Dimon or even Elon Musk today talk about what are challenges to their businesses, I think investors need to think the same way within their portfolios, reducing beta, upgrading quality on rallies, and that's just intelligent. That's running the ball in a very difficult environment to play offense.
Yeah.
And so those are the things we're doing.
Adam Parker, rally over. Earnings need to come down. Fed tough. Were you shaking your head no way as Rob was saying all that?
No, I think Rob is right that high-quality stocks beat junk or low-quality stocks by about 2% per annum. They outperform by more in risk-off tapes. So I of course, don't want to own low-quality, expensive stocks. I think that part makes a lot of sense. And there's a number of sectors and industries where things have gotten kind of stretched and expensive. I think that's right. I don't know if I totally agree on the earnings part, meaning, yeah, I think earnings estimates have to come down, but I don't really think that matters. I think what matters is, do I believe earnings will be higher next year than this year? So over the last years, since 1978, as I mentioned, when forward earnings data started, on average, the analysts think earnings growth will be 14% at the beginning of each year, and the actual growth's been 7%. So the downward revisions haven't mattered. What's mattered is my belief that earnings can still grow. So I get there's uncertainty, but as long as people think that the numbers are going to be higher, then the whole system earns more money, then I'm not sure you have to get too negative on equities if you think earnings will grow.